Good afternoon, everybody. Welcome to another edition of our client-facing calls with the Raintree webinar series here. That was David Bowie and Heroes. That song was released 43 years ago today, so that would be a good thing to throw out there for a little intro music. Graham, you remember that, don't you?
Oh yeah. No, I was 30, 35 by then. Yeah.
Yeah, there you go. Yeah. My name is Adam Durgis. I'm here with Graham Koehler and Dan Pembleton. I'm one of the founding partners of a company called Raintree Financial. Dan is the founder of Pavilion, and Graham Koehler is a longtime friend of mine. We go back about 15 years, and he's their wholesaler. So, guys, we're really grateful that you could spend the time with us today, and grateful to all the clients on the line who decided to invest a little bit of their time today. So Graham, I understand we're going to start with a little bit of a video today.
Yeah, I think we've kind of progressed from a static PowerPoint to a bit of a video presentation. It lasts about 15 minutes. It's pretty comprehensive, and kind of like it because it gets a lot of information kind of a little bit more condensed than me rambling on with a PowerPoint. So sure. When you're ready, I'll...
Yeah, let's do it. And for those on the line who haven't been a part of these, I would ask that you take your questions, and instead of putting them in the chat box, I would ask that you use the Q&A box instead at the bottom. So you'll see at the bottom of the screen, you'll see a Q&A and chat box. Please use the Q&A box. Excuse me. Please use the Q&A box because it makes it a lot easier for me to keep them organized as to what's been answered and what hasn't. So if you could do that, and what I will be doing with your questions is if I feel like it's something that I need to interrupt Graham and Dan on the spot, then I will. And if it's something we can save till the Q&A section, then I'll save it. But we'll make sure everything is answered today. So with that said, I'm going to turn my camera off to save a little bit of bandwidth. And Graham and Dan, you can do the same. And then when we get back to the Q&A, we'll turn them all back on. So Graham, you should be able to just share your screen there.
Yeah, I'm going to share that one. So hopefully you can see something.
I see it.
Okay, thank you very much. Welcome. My name is Graham, and I'm the Vice President of Business Development for Excellent Capital Management. According to the Fraser Institute, the combined federal and provincial top personal tax rate has risen each year in every Canadian province since 2009. High-income earners now pay anywhere from 47% to a staggering 53% in income taxes at their highest levels. Today, I look forward to sharing with you a federal government tax reduction strategy that's been around longer than both RSPs and TFSAs, and see if it's a fit for you. The Flow-Through Share program has been in our Federal Tax Act since the mid-1950s and provides for over 100% tax benefit to participants for every dollar purchased of Canadian resource company flow-through shares. It is one of the few remaining advanced tax reduction vehicles available today. This major tax incentive is allowed in anticipation that alternative energy, oil and gas, or mining companies will use the money to explore for, discover, and develop new resources, in turn helping promote remote communities and employ thousands of people in the process. The Flow-Through Share program has proven very beneficial over the years for both investors and the country as a whole. According to Natural Resources Canada, the mineral sector alone accounted for 634,000 direct or indirect jobs in 2017. So what exactly is a flow-through share and how does the program work? Well, a flow-through share is simply a special type of common share sold by a Canadian resource company to help it raise capital for exploration. However, it is quite common for these companies, especially the smaller ones, to have no net income for tax purposes. So they find themselves with no need for the tax deductions related to the expenditures incurred in their exploration activities. The federal flow-through share program allows the company to transfer or renounce these expenses directly back to the investor. Purchasers of flow-through shares can then deduct the expenses against their own personal or corporate income taxes. In other words, the resource company's exploration expenses are simply flowed through to the investor, thus the name Flow-Through Shares Program. The main deduction in the program comes in the form of a Canadian Exploration Expenses, or CEE credit, which effectively reduces the investor's taxable income by 100% of the amount invested, thus reducing taxes otherwise owed in the year the investment is made. The program worked very well for many years. However, during the tech bubble in the late 1990s, investor interest began to decline in resource investing, prompting the federal government in the year 2000 to introduce an additional tax incentive into the program known as the Mineral Exploration Tax Credit, or METC, on mining company flow-through share purchases. In the industry, this is known as the super flow-through and comes in the form of a federal 15% investment tax credit. The combined CEE and ITC credits for individuals of 115% enabled the sale of junior resource company flow-through shares to again flourish. Canadians can participate in the flow-through share program by buying units in a professionally managed flow-through limited partnership and gain the benefits of professional management, as well as a diversified portfolio of shares from many different exploration companies in one fund, which helps to mitigate risk. Excellent Capital is a boutique investment firm located in Toronto that specializes in alternative assets, commodities, and discretionary portfolio management. The company is licensed as portfolio manager, investment fund manager, commodity trading manager, and exempt market dealer. Excellent Capital was founded in 2002 by Mr. Daniel Pembleton, who's been working in the financial industry for over 27 years. First as a trader on the Montreal Commodity Exchange, then nearly a decade with RBC Dominion Securities in institutional fixed income, where he rose to the level of Vice President Global Money Markets, managing a portfolio valued at over $3 billion. From there, he founded Excellent Capital Management to provide investment advisory services for third-party and proprietary funds, individual managed accounts, and structured investments. As a former institutional trader, Dan has priced debt and credit through various recessions and world crises. Mr. Pembleton's education includes an honors BA in economics from Brock University, an MBA from Western's Ivy School of Business, and a chartered financial analyst designation in 1998 from the CFA Institute. Dan is supported by a team whose areas of expertise include analysis, operations, client services, technologies and workflow, as well as marketing and business development. Excellent Capital has designed a number of private equity funds over the years, covering various distinct asset classes, but the longest running offering has been the Pavilion Fund. Pavilion has already helped close to 1,000 high-income earners lower their tax burden, while at the same time diversifying their portfolios into Canadian natural resources. Pavilion has been, by net asset values, the top performing flow-through fund in Canada for 3 of the last 4 years and in the top 10 for the past 6 years, even during some of the most volatile markets in recent memory. Here, we see Pavilion leading all major competitors in the years 2015, as well as 2017, and again in 2018. Let's hear from Mr. Dan Pembleton on what helps the Pavilion resource funds outperform the competition.
We saw how Canadian resource pioneers were generating billions of dollars in resource-related wealth and created a flow-through fund that would act as a blueprint for investors looking to replicate this investment style, with the added benefits of tax deductions, a unique hold period of 3 to 6 years, and cash returns. Pavilion funds differentiate themselves in the field by seeking absolute returns on investors' capital and not simply relying on the tax benefits. A diversified portfolio of small to mid-cap natural resource stocks can produce better than market returns over measured periods of time. Using oil and gas, as well as mineral and mining stocks, increases the universe of stocks to choose from and can provide better diversification than either sector alone. An average portfolio will carry as many as 20 or more different resource company stocks.
To help clarify how the numbers work, let's pencil out an example for a client we'll call Bob, who lives in Ontario with his wife Mary. The numbers in the example are approximations and won't be 100% accurate, but they will be close enough for illustration purposes. The assumptions we will use are that the value of the fund on maturity is exactly the same as when purchased, and that Bob's marginal tax rate when monies are returned has not changed. The calculations will be more nuanced in a real situation, but again, we'll try and keep it simplified. Bob's taxable income, even after an RSP contribution, is $200,000, leaving him with a tax payable of $70,000. If he were to purchase, say, $30,000 Pavilion flow-through fund, his new taxable income would be reduced by the CEE credit to $170,000, leaving Bob with only $55,000 owing in income tax, saving him $15,000 in taxes this year and leaving only half of his original capital at risk in the investment. Additionally, once the super flow-through credit of 15% is taken into account, Bob will reduce his taxes by another $4,500 for a total of $19,500. In reality, the total credits will be reduced somewhat in the first year due to expenses of the fund. However, these amounts will be amortized and recovered over the life of the fund and reported in Bob's T5013 tax slips each year, giving him small additional yearly deductions. Typically, there's about 100% in tax incentives realized in the year of purchase and the remaining in the following years. As mentioned previously, any and all monies received back by Bob over the life of the investment will be taxed as capital gain in the year invested, due to the ACB being zero. In our example then, Bob would receive the original amount invested, $30,000, back over the life of the fund, and half of that would be taxed, giving him a $7,500 tax liability. But remember, he received around $19,500 in total tax benefits, so even though the investment did not go up in value, Bob is ahead by about $12,000 on his $30,000 purchase in the program. This equates to a 40% return on investment, even though the fund only returned the same $30,000 originally invested. Additionally, if Bob had some unused capital loss carryforwards from other investments in his portfolio, he could now use them to offset some or all of the capital gain owed. Using unused capital losses and flow through in this way can be a very strategic move. We've seen the power of using flow through for tax savings and portfolio diversification, but there are a couple more ideas that I wish to bring forward. First is the benefit of using what's called the Pavilion ladder effect. The Pavilion flow-through ladder works in a similar way to a bond ladder in that it helps to diversify the investor over many Pavilion funds and reduces the reliance on any one fund's specific performance or maturity timing. The investor simply purchases some Pavilion LP units yearly for 4 or 5 years as a program, providing a yearly stream of tax savings and cash proceeds from both the periodic and the final distributions from the funds. If we did this over many years, you would simply be climbing the ladder step by step by essentially using previous tax refunds and cash distributions to offset future purchases. In our example, Bob purchased $30,000 of flow-through and received approximately $19,500 in tax incentives. If he did the same in year 2, the result would be similar. In year 3, however, Bob would technically be using the past tax refunds to fund the new investment, again receiving a tax refund. The ladder effect can be repeated as often as Bob wishes. Of course, he will also be receiving some cash distributions from past funds, which would speed the process up even more. Laddering investments in this way is very strategic. The second method of utilizing flow-through is to help offset a large one-time lump sum from any source. In this case, Bob and Mary have owned a small commercial building for many years and are thinking of selling it. This will leave them with a substantial capital gains tax payable. A one-time larger purchase of flow-through can help reduce some of the risks of this tax burden as well. So let's bring it all together. Flow-through is the only significant tax shelter available today, and it's a smart vehicle for high-income earners and those who realize a large taxable lump sum from any source. The PM has over 25 years of experience in finance and has successfully launched and managed 16 Pavilion funds to date. The current fund is now available for sale, but will be closed for new investment on December 15th of this year. So I would encourage you to speak with your advisor.
Okay, there we have it.
Sorry, I was on mute there. Good job, guys. That was great.
Thank you.
So now I know you've got some slides that you're going to go through as well on top of that. I thought that was a really good intro. You know, while you're getting these loaded up, Graham, just one of the comments I'd like to make is you know, historically, I've not been a fan of a lot of flow-through companies. And the reason that I've not liked a lot of flow-through companies is that it seems like many of them really focus on the tax savings and not the investment. And you know, one of my mentors, who's a retired accountant, he always says, you never let the tax tail wag the investment dog. And it's something that I've always been really impressed with the Pavilion team, is that this is an investment first that has some great tax benefits to it, not the other way around. And so I'd love to dig in on that a little bit and talk about maybe why you've been able to find more success than a lot of your competitors on the investment side.
Yeah, sure. And I'll defer to Mr. Pembleton on that. He can throw in his comments. And my question is to you, Adam. Seeing as though I was around 30 years before that song you played at the beginning, my memory sucks. What slides was I supposed to bring up?
Well, some of the slides that you had up when you presented to our advisors last week. Okay. That'd be okay. We're talking about some kind of fund performance and you know, how you guys have done relative to your competitors, things like that.
We can. That's the performance update.
Right.
I think what I'll do though is, and there's a reason for it. I'm just in the middle of actually having some changes done on that, so I don't want to show it.
Okay.
And they're not significant changes. They're just some wording changes that I want to do in a couple of the slides. So I don't want to bring it up, but nothing has changed as far as performance. And I will say that without showing the slides, that Pavilion has been actually in top spot in Canada, including, you know, all the stock brokerage house type of products as well, flow through products. What they call the IROC or prospectus products. We've been in top spot in Canada 3 of the last 5 years, second place in 1 of the others. So basically first or second spot in 4 of the last 5 years. So
wow.
Quite proud of that.
That's great. Well, maybe then what we could do, would you have something where you could show a real example for a client? Like, let's say we take a client in BC or Ontario or somewhere, and show the real example of like how the investment works and the write-off they get and all those things.
Sure, and actually I'll load that while Dan speaks to your question.
Sure.
Sure. Thanks, Adam and Graham. So, yeah, Adam, you're right, and I appreciate you pointing it out that Pavilion is an investment first, and it comes with some amazing tax benefit. And that actually goes back to how I, kind of discovered the sector. I discovered that people were doing this in the sector. I didn't actually create it, but it started with, I got exposure to some of the activities that some of the elite resource investors in Canada were doing, and I just couldn't believe the kind of returns that they were getting. They were amazing, and so I dug into it, what they were doing, and how they were doing it. And along the way, I also discovered this flow through angle on the same stocks. So I actually came about this fund in a very investment oriented way. I was researching the underlying investments and also discovered that there was a way to do it with amazing tax benefits. And so what ended up happening is I put the two together, and the reason we outperform comes down to basically 3 things that we can do in this fund that I designed into it, that one, elite investors can do, and that other funds were kind of leaving out. The first one is the longer hold period for the fund. So you can't, people talk about buy and hold. This isn't a buy and hold fund. You're not going to have it 20 years from now. But but that's, by the same token, though, you can't expect a lot of investment performance in 12 months, luck or coincidence. So we designed it with a longer term to it, and that just flows with the way that the investments itself actually work. I'm getting my internet connection is unstable. I'm going to turn off my video for the rest of this. So yeah, and then so the longer hold period is the first aspect. The other one is that we don't roll into another fund. We do a cash on cash distribution, and by doing that, while we eliminate some costs and we eliminate some noise along the way, but that also allows me to manage each of the fund holdings individually and not as, you know, an entire group. And I kind of liken this to, you know, apples on a tree. You know, some are ripe, some are not. We pick the ripe apples as we go. The stocks are like that too. They don't all march to the beat of the same drummer. And so being able to take profits on one stock rather than the entire portfolio when there might be many stocks that haven't hit their greatest advantage is the other thing that allows us to do it. And by being systematic about this over the years, we've been very successful at it. And that comes down, you know, I think, to emulating the lessons I learned from very successful investors in the field.
You know, you talk about the success, you know, for those of you who are learning about this concept for the first time, if you invest in this, you invest in a specific series, right? So you aren't just buying into one ongoing pool. You buy into one specific series that has its own, you know, like it's its own deal. It's its own investment. So what percentage of those funds have exited profitably since you started this?
In profitable exits on a tax adjusted basis, you know, I don't have that specifically in front of me, but so I'm just doing this from memory. 1, 2. So I guess we've had 4 of the 5 that have exited profitably. One was victim of some unfortunate timing, which would be 2009. And we've got in the rest of the series, you know, 2012s and to the newest fund, which would be 2019. All of those are, they're not exited, not all of them. Or not any of them are fully exited, but they are all in a profit position on a capital at risk basis. So and some very, very profitably. So and they're all, you know, 2012s have about 40% of their money has been exited. The 2013s about 40% as well. 2014s around 30% exited, and down to, you know, 5 or 15% for the newest funds.
Yeah, that's great. You know, you talk about the different time frame and the different duration that you have compared to a lot of your competitors. Maybe talk about that. Talk about, I know you don't want to talk too much about other funds, but you know, my understanding is that a number of flow throughs, they've got a set exit date, right? Like it's a year or 2, whatever the number is. And you mentioned that really kind of handcuffs the fund manager. You know, it takes away a lot of their discretion and maybe forces them into selling at a time that might be less than optimal. So with that in mind, like, you have that extra discretion. So what what makes you pull the trigger on an exit? What is it? Just a profit? Is it just, the right timing? What goes into your decisions when you do decide to start to sell some of these off?
It's all of those. It's sort of its outlook, it's timing. One of the things, the adjustments that we have made, which does help us, is that we have put the 64-month hard limit in there, which I think actually gives investors some more assurance about the exact timing, and still provides me with plenty of flexibility around things. I tend to, when I look at exits, I'm looking more at the individual stocks, Adam, than I am at the fund overall. So what ends up happening is I'm looking at stocks, and some will go up a lot, and they might be going up a lot with not a lot, I don't feel a lot of reason for it at the time. So we would sell into that and take some money off the table. Other stocks might go up a lot for great reasons, and we might sell less of that just to see how far that will go. And that's also critical, because this is how we make the big returns, is that we neither sell too soon or too late. So it's important to manage these stocks. Other stocks, there will be stocks in the portfolio that just don't perform for whatever reason the way we want, and we'll get rid of those stocks, and because it's better that we return the money to clients, and hopefully, and they most often do. We have a very high reinvestment rate. They'll return it to us to put to use in a new portfolio with new prospective stocks. And so what happens is, over time, we find different profit-taking opportunities and timing in the stocks, and the fund will start to naturally be liquidated, and then we get to a point where it's like, okay, we've got X amount left. It's just time to wrap up the fund and move on to another one.
Right, that's great. I think a lot of clients, and Graham, we'll get to your example here in just a minute. I don't think it takes a lot of foresight to recognize that we're most likely in a higher tax environment sometime in the near future. We don't know anything about the future. Nobody, all bets are off in terms of trying to predict where this crazy world of ours might go. But there does seem to be a lot of consensus around the thought that taxes are probably going to go up in Canada. So it's not difficult to look at this from a timing perspective in terms of the tax side. But why is this a good time to be investing in this sector from an investment standpoint? Why does it make sense now to be investing in this sector?
Sure. And I'm glad you asked the question. I'm working on a piece that will try and draw as many different reasons why as the timing, I think, is exceptional, and it is exceptional. This is probably the best time that we've had, one of the best environments that we can go into it, and it really comes down to we've only got so much time on this webinar, but the biggest fundamental reason for this being a good time is that it really hinges on the price of gold and precious metals. And so when I say gold, I really mean the larger family of gold, which is precious metals, so gold and silver, platinum, those kinds of those metals. And gold can be thought of as equivalent to a AAA credit bond. And the reason we can think about it like that is gold is a great credit because gold is gold. It doesn't require somebody else to pay anything. It's just intrinsic value. So when you have that, it's assurance of payment is the same as any AAA credit bond that you can have. And the reason I think of it as a bond is you've taken out the credit risk and you have this asset that you can always redeem for cash, and that's very similar to government bonds. But now we have this environment where central banks have had to bring interest rates basically down to zero, and so gold has always competed for investment attention with bonds. And the biggest knock on gold was always, well, gold doesn't pay you any interest. And we've kind of eliminated very much that hurdle with respect to gold. And in fact, if you dig a little deeper, gold really responds to what's called the real interest rate. The real interest rate is the nominal or headline interest rate that you would see less the inflation rate, because if you're getting 1% interest, but the inflation rate is 2%, and that's a government reported inflation rate. We all know it's higher than that. Our own living inflation rates always seem to be higher than that. But when it's 1% interest and 2% inflation, the real interest rate in that case is actually minus 1%. You're losing purchasing power every single year. And so again, you've got gold, which is an inflation hedge, gets even more competitive with bonds in that situation. And so we've got basically the greatest macroeconomic background in favor of gold that we've ever had in our lifetime, because interest rates have never been this low, and that's the big competition that we've had with gold. And so we see, and we've already seen it go up, but we think it'll go much higher. You get people like Warren Buffett, who has called gold a pet rock, has not been a fan of gold, and yet he dropped nearly $600 million on buying some shares in Barrick Gold, the biggest gold miner in the world. So he might not like gold, but apparently he likes the gold business. So and he's getting involved. So this is the kind of background environment that we've got. And by mentioning Warren Buffett, that's his first foray into gold and precious metals. And that's also reflective of the fact that people globally are underinvested in the gold and precious metals sector, much less than they were in, say, the 1970s. Right now it's estimated that gold's percentage of portfolios the world over is about between 0.3% and 0.5%, compared to in the 70s when it was around 3 to 5%. So, this is an under-owned sector that has a serious macroeconomic advantage. And you add that to the fact that we have just come off of a very long bear market, and all these factors are starting to come together.
That's great, Dan. So do you like, what's the weighting going to be in the portfolio in gold? I mean, you talked a lot about gold. What's the weighting now, and are you planning on increasing that as you move forward?
Well, as you said, each year is its own discrete portfolio. Last year I bumped it up because I was getting very bullish on gold. So we bumped it from a weighting of about, in say prior years, weighting of about 40 to 50% last year. We bumped it up to around 60, 70%. I'm comfortable with it being in the 60, 70, 75% range still, and I think it should be there. I am a portfolio manager, so diversification does still play in, even if I really think things point to one sector. So we will have other exposures in the fund. We will have some base metal exposure. We'll have some what we call grid metals or electronic, going along with the electrification of the world. We'll have those kinds of exposures as well, and even a small bit of oil and gas. But yeah, we'll have a heavy overweight in gold.
That's great. Just going to go through, there's some questions here that I've not addressed yet. Actually, Graham, before we get to these, why don't you load up that example? You've been ready for a while there. Why don't we load that up? Because I think that'll probably lead to some other questions as well.
Well, that's what I was thinking too. We can get through this pretty quickly, I think, here. Yeah. So this is really, it's not that unlike the whiteboarding in the video. It's just a little more visual and detailed. And this is actually a couple of, not that it really matters. This is based on, I think, 2018 tax rates. It's always changing, but let's just pick a province. These are actual calculations, by the way. So this is a little bit more specific. So if you pick the first column, British Columbia, so this would be a person that has $200,000 in taxable income. They would have, at those tax rates, had to pay just over $65,000 in income tax that year. Assuming they had no other deductions, but this is on taxable income. So they would have paid around $65,000 in tax. If that person had bought, say, $50,000 in Pavilion flow through, they would have less a little bit of the offering costs. And that's just, quite frankly, commissions paid and hard costs and legal fee, just things like that on the fund in the first year. So if they bought $50,000 of flow through, they would have got a $44,800 CE deduction for year one, for the year they invested. So that reduces their income by $44,800. So instead of, which is similar to how an RSP works actually in that respect. So instead of having a taxable income that year of $200,000, they'd have a taxable income of $155,200, which reduces, of course, their tax payable, in this case, to $46,296. So that's already taken them down almost $20,000 in taxes owing on the $50,000 they invested. But if you recall in the video, we talked about that second bonus, if you will, or the super flow through, which is an additional 15% investment tax credit that gets added to this. And in this scenario, that was just over $5,000 in an extra credit. So his new, in this case, tax payable dropped down for this year, or the year of the investment, to just over $41,000 from 65 he would have originally owed, saving $24,500 in tax. So that's actually quite specific for this. This is a fictitious person, but it's quite a specific calculation. And each province, the only real differences of being the provinces is the tax rate. Is the various provincial tax rates. So it basically carries through. So as you can see, in general terms, actually more than general, quite specific terms, in the BC example, a $50,000 investment for this client saved them virtually half, saved them a little over half, $25,000 in taxes for the year. So when Dan was talking about at-risk capital, that's what he's referring to. The investor has invested $50,000, but they've gotten about $25,000 back this year in tax refunds or tax benefit. So their at-risk amount is only $25,000. So that's, you can, and if you look at the other provinces, it's all virtually the same except for the tax rates.
Now, when it exits, Graham, talk about the tax consequences upon exit. Right,
and that's a significant feature of flow through in that when you look at this example on the screen, this is this client's income tax, or their highest using their highest marginal tax rate. So of course you're paying the highest amount of tax when you're paying income tax versus capital gain. So you're getting the deduction at the highest rate, which is very beneficial. And when any money is paid back, and Dan mentioned that some of it's paid back, almost on a yearly basis. We tend to send out a little bit of cash on the funds, and then there's a final exit. All monies paid back are taxed as capital gain, which is half taxed. So you've really converted income tax payable this year at your highest marginal tax rate into a future capital gain, which is half. And that is the significant feature of flow through.
That's great. Let's get back into some of these questions here, because there are some. Dan, do you ever track your like the performance of each fund like in certain time frames? Like there's a question here asking about how the various funds are doing in 2020 relative to your competitors, just with all that's going on in the world.
Well,
that might be a tough thing to answer.
It's a harder one, I guess. Our last, the performance that Graham is updating right now is as of July, and so the answer is, I don't watch it on a regular basis, but I happen to know it just because we updated in a couple of months ago, and the fact is, in 2020 we are outperforming. Our 2019 fund is outperforming all the other 2019 funds out there. So that's one of the 3 years where we're number one. 2019 is one of those.
Okay, that's great.
Those funds close at the end of the year. That actually represents our 2020.
And just as a kind of an extension of that, because I was just talking about at-risk capital. Your at-risk capital is typically about half of what you invest in the highest tax rate. So the 2019 fund is up about 200% for our investors in the first 10 months here from their at-risk capital.
Okay, that's great.
Yeah.
How frequently do you put?
I just want to jump in, just because we were talking about at risk, and so it's a timely stat. If somebody invested in every single one of our funds from 2008 on, their return on at-risk capital average over each one of those funds is 111% as of July. So while the 2019 fund is certainly a big performer, actually there's all kinds of good performance all the way through that, and that kind of plays into how we like to see people serially invest in us, because it takes some of the timing risk out of it. And again, I'm going to mention too that result was done. So that's over all time. We started in 2008, and the bear market started in 2011. So that 111%, the majority of the data that feeds into that result came during a 9-year bear market.
Yeah, it's a really, I'm glad you made that point, Dan, because that does stand out for sure. Talk about the frequency of the investment series that you put out. Is it like you put out 1 a year, 2 a year? The question comes in that it sounds like you could kind of ladder these investments. People invest year over year in that. Is that a strategy used, and what is the frequency of funds being released?
Sure, we have done in prior years. We've done 2 per year, depending on demand and how we were working through things. For the last 5 years, we've only done 1 fund per year. We constantly debate back and forth whether we'll move to a 2 fund per year structure or not, and we'll have that internal debate again. I think because we're in a bull market, that a 2 fund, there's a strong argument to be made for returning to a 2 fund per year structure in a bull market. So I can't, the decision has not been made because we haven't even made the debate yet, but I would say there's a much higher probability that we'll do 2 funds in 2020 than so currently we do 1, but it's been like I said, it's been a bear market, and I think that's 1 is enough.
Yeah, and the main point is, we do minimum 1 fund every year, so clients can absolutely ladder this, or do consecutive yearly buys to mitigate risk.
Right. I'll ask one more question, and then we'll turn it over to you for some closing comments. We do want to get this done at the top of the hour here. And I really like this question. Dan, is there always sufficient quality supply of resource companies available to allocate capital to each year? Or do you find yourself, at times, if you've got maybe more money than you feel comfortable with, do you end up kind of settling for some that are just okay?
That's a great question. And that's a question that should be asked of every investment manager, no matter what they do, whether it's traditional or alternative or whatever. But it's a great question. We don't. I don't have that problem, and the reason being is that there are a lot of stocks out there to choose from. We spend a significant amount of time watching them. And adding, we have a very, very long, and it's called our watch list. We have a very, very long watch list that my analyst updates me on every day, actually, with any news that comes out about any of those companies on the list. And so, we're watching, 100 or more companies, and so we don't have that problem, but it does actually feed to another important point that we have anticipated, that that could be a potential problem in the future. And what I have notionally always done with the Pavilion Fund is I have said to people from the very beginning that I will only take $20 to $25 million maximum per year into this fund. And the reason being, part of it is the deal flow, making sure that we have the highest quality deals. I like being number 1 3 out of 5 years. I don't want to lose it by diluting ourselves and taking too much money on our strategy. The other part of the strategy is, you know, I notionally want very high returns for investors. And so that means I also have to be able to sell a significant amount of stocks in older funds every year. If I had too much money, that would make that process difficult. So, so the answer to the question is no, we don't have a problem, and that we've anticipated that that there are limits in what we can do, and we've already restricted ourselves.
Yeah, and just for everybody's knowledge, like that number there, that number of like a cap of 25 million a year, that's like a boutique number.
Yeah.
Which again, I love that. that's a good thing, not a bad thing. There are certainly some investment strategies where bigger is better, bigger is safer, things like that. I would not necessarily apply that rule to this space. In fact, you could probably make an argument that smaller is better, which I think, you know, Dan, you've done a great job of today. So we're at the top of the hour. Thank you both for taking the time, and thanks to all the clients on the line who decided to invest a little bit of their time with us today. Thanks, everybody. Enjoy your day. I'm sure if you're on this call, you're curious to see what our Prime Minister is going to say today in his throne speech. So I'm guessing a lot of you are jumping straight from this to that. Thanks, everybody, for your time today. This was a great call, and Dan and Graham, great job as usual.
No worries. Thank you.
Thanks, Adam.
Okay.
Bye.
Bye.